At first, Uber looked unstoppable. From San Francisco to Sydney, it moved fast, disrupting taxis, challenging regulators, and becoming the face of the gig economy. But speed comes at a cost. When Uber pushed into China, Russia, and Southeast Asia, it faced something it wasn't used to: fierce local competition and governments that didn't back down. In China, it went head-to-head with Didi Chuxing. Both companies burned billions in subsidies, free rides, driver bonuses, promo wars. But in the end, Uber lost. It sold its China operations to Didi in exchange for a stake. In Russia, it collided with Yandex Taxi, a homegrown favorite. Instead of going all in, Uber merged operations, keeping a minority share, but losing control. In Southeast Asia, it met Grab, fast, local, and deeply embedded in the region. Again, Uber exited. Another sale, another equity deal. Same pattern. Different countries. Uber didn't fail because the idea was wrong. It failed because it underestimated localization and overestimated the power of a global brand. While it brought capital, tech, and ambition, local players brought deeper cultural understanding, regulatory ties, and street-level insight. Uber learned a tough lesson. You can't copy-paste success across borders, so it pivoted. It stopped trying to win every market and instead focused on equity partnerships, profitability, and consolidation. Today, Uber still earns from those regions, not by operating, but by owning slices of the winners. And that's why this case study matters, because it shows students that global scale isn't enough, gives educators a real-world example of exit strategy and equity trade-offs, and reminds professionals that in international business, ego must bow to local reality. This case is now core in global strategy, competitive dynamics, international business, and M&A strategy courses. Follow us for more real-world case studies where expansion isn't just about growth, but knowing when to step back.